Appreciate everyone being on. Welcome to those that are joining us via Facebook.
A sinister explanation being offered up by the attorney for the young armorer on the film. Is it possible that a disgruntled crew member—
I need everyone to mute themselves.
Only contain blanks. Let's turn with what's—
Thank you so kindly. We want to once again welcome everyone joining us via Facebook Live to our financial evangelists for the past. This is our fourth week that financial evangelist Jenny Jones is with us. And I can't believe he only has 2 more weeks with us. We only have 2 more weeks to go. This has to be the fastest 4 weeks in the history of time. And we've just enjoyed ourselves tremendously, and we've enjoyed the information to make our people wiser in regards to money, that when the Bible declares that he has called us to be the head and not the tail, that we have a responsibility being the head. That means that we are not people that make decisions based on emotions. Being the head means that we are rational. We make decisions based on information. It means that we use all of our senses. We do not follow our tails. The tail is not wagging the dog. So I thank God for the ability to be the head and not the tail, and that the Bible declares that we are destroyed for a lack of knowledge. We're not destroyed because of a lack of faith, but we are destroyed because of a lack of knowledge. And I want to thank Jenny Jones for sharing the knowledge that God has given to him through his word and through his experiences. So at this time, I'm going to invite you to bow your heads for a word of prayer with me, and then we will not delay any longer, and we will turn it over to our financial evangelist, Jenny Jones. Our Father, now God, we thank you for your manifold blessings. We thank you already for what our eyes have seen, our ears have heard, our hearts have felt, our minds have thought. We pray that your spirit would once again impart wisdom, knowledge, and understanding to your people. We thank you for the opportunity that we can do better because we know better. We ask all these blessings in Jesus' name. Amen. Jenny, it's all yours. No, you're on mute, Jenny. And before he comes on, I'm going to once again ask everyone to mute your device till it's time for question and answer. Kindly mute your device. We can hear any background noises or background talk. So Elder Garcia, you are the host, and I am not able to mute anyone. So please mute yourselves. Thank you so much.
Yeah, I appreciate you allowing me to be able to present again for your church and these people you pastor over, and that's who God has put underneath your leadership. We are in week number 4, and you are right, it is moving pretty fast. My wife is just saying, man, you're on week 4 already. So tonight I am gonna, as we move a little bit further down, I am gonna ask a few questions, just 1 or 2, just for check for reasoning and see if people are understanding where we're at. So let's go ahead and get into it. Let's go ahead and, this is week 4, as we talked about here. Let me see. All right, so week 4, retirement planning fundamentals. We've already gone through week 1, biblical foundations and what the Bible says about money, and an introduction to financial stewardship. Week 2, we went into the introduction of money and financial instruments. We talked about money market, stocks, bonds, some of your basic instruments, savings accounts, things of that nature. Last week, we went into investment fundamentals, which is very exciting. You guys got pretty involved into that one, but if you got involved into that one, you're definitely going to take off here. This is probably going to hit a lot more people on this call and or streaming than anyone else. So this is retirement planning fundamentals. Again, it still falls underneath the stewardship particular piece right there. Just so, Pastor, if you go under the mute, you can mute. I just want to let you know we can't hear when you move. So if you just wanted to.
Yeah, my elder is actually the host and he needs to mute. I am not able to mute anyone.
No, I'm talking about yourself.
I was muted. I think that's my elder Lee Tom.
Oh, okay. Okay. No, you're fine. I just want, can everybody still hear me? Because it seems like I got cut off.
We can hear you.
Okay, I was gonna say, Elder, he muted me too. No, it's fine. I just wanted to make sure. All right, so stewardship. Again, this is one of the elements. The last couple of weeks we were talking about just managing the resources that God has placed you over. And if you are untrustworthy about worldly wealth, who will trust you with the true riches of heaven? Luke 16:11. And I think we had already kind of broke that down a little. We talked about wealth. We talked about the attitude of wealth and or money. But we talked about the stewardship piece, knowing, understanding, being knowledgeable of the necessary resources that are out there and available to you to be able to make intelligent, wise decisions. And again, being the head and not the tail in all your decision making and all your understanding. And all your knowledge, getting a good understanding is very important. And all your education. We talked about a balanced stewardship, having a balance of, 1 Timothy 3:1-5, 8-9. Timothy is a book, obviously, when they talk about leadership and creating elders throughout the church and talking about just good stewardship, good management of the resources that God has placed you over. This was a good fundamental start that I teach to all the kids, I teach to all the teens, and I teach to all the adults, and I try to govern my own finances. Being in leadership at my church, I try to govern my finances, making sure I'm making all the pieces move and do them work the things that they need to work. 10% donation, 10% investing, 10% saving, 70% spending. Right, operating my household, trying to make sure that the lights stay on, and those types of things. And so I have the particular scriptures there available for you. But let's get into retirement planning fundamentals. Wanted to just give you a prelude there. This particular session of this week is being sponsored by My Retirement Exit. My Retirement Exit is a, can now see your screen. Okay, so My Retirement Exit is a, that is a company that, everybody's good? I think a Philly needs to mute themselves. So retirement planning fundamentals. Retirement Exit is a company that I run. Being an advisor, I run a different element that only covers retirement. In this particular week, since I'll be using a lot of the fundamental things that I teach in some of the classes that I instruct, I just wanted to let you know that My Retirement Exit is one of the companies that I do actually run. And I think that was even in my bio when he talked about it. Okay, so let's go ahead and break into this. All right, so I want to make sure we're good here on time. So let me just give you these. I want to break it out. I want to start out with these two core elements, these two pieces here. Defined benefit plans, and I want to talk about defined contribution plans, right? I don't want to give you a high level. Again, these are fundamentals, but it's just so that you would understand when you see them, you'll be able to identify them in your own retirement, on your retirement journey. The defined benefit plan is them, and defined contribution plan is you. And when I say them, the defined benefit plan, the benefit is defined for you when you, the benefit is defined for you when you actually start, right? So when you actually start with a company, let's say and these used to be very prevalent way back in the 50s and 60s, and the industrial age is when you could go and work for, are we good on that, or is that something that's chiming?
You have individuals coming on.
Oh, okay. I didn't know what that was. I was like, what's going, is my time up or something? All right. So,
No, no.
no, I had never paid attention to that, but okay, sorry. So listen, let me get back on point. So defined benefit plan, back in the 30s, 40s, 50s, industrial age, the defined benefit plans were very prevalent, right? The factory workers, people working on the assembly lines for General Motors, and so on and so forth. It's when your benefits were defined
Where's your
for you.
volume? Where's your volume? I don't know.
It's when your benefits were defined for you. And so when your benefits were
I never
defined
know
for
where the
you,
volume is.
Mr. Butler or
I'm
Mrs.
trying to mute.
Butler.
I'm
Okay.
trying to mute them.
Yeah, help me out, Doc. It's throwing me off a little bit. You all right? All right. So it's when your benefits were defined for you. So when you started working for an actual company, they would say, listen, if you work here 20 years, we're going to give you, 3%, 4% of your annual salary, over your lifetime or something like that. That's when you showed up day one, your actual benefit was defined for you. They already told you, work here 20 years, you get a gold watch, 2%. Work here 25 years, you get a gold watch and a gold pin and you get 3% or something like that. So your benefit is defined for you. So that's a defined benefit plan, right? And that's them, meaning they define it for you when you show up. And then the second component, because normally retirement falls into one of these two categories, or may fall in, and you may get a combination of both. So the second one is defined contribution plan, is when you define the contribution, right? And you may start working for someone that says, hey, you need to contribute to your 401k. And then they say, how much can I contribute? They say, hey, you can contribute how much ever you want. There's a limit, an IRS limit, but you can contribute as much as you want. You define the contribution towards your retirement. And so when a lot of the defined benefit plans went away, the defined contributions plans started to pick up and they became more popular. And so a defined contribution plan really more than likely works off, actually, most of them work off IRS codes, right? So this person says, what is a 401k? Well, if you look at IRS code 401 paragraph K, it'll actually explain to you what a defined contribution plan and what the parameters are for a 401k. All of them, 403B is IRS code 403 paragraph B, right? And that's for teachers and nonprofits, right? And they're telling you how they're structured. And really the defined contribution plan came about, it was really an IRS code that people use to defer compensation. And that's kind of the history of that. And you will find probably less than 5% of companies still use defined benefit plans. That's a whole nother subject, and the reason why. Most of them, 95% of them, will have a defined contribution plan. If you belong to a company that's been around for some time, they will have a combination or a hybrid of both, or they may have a little bit of one and then a little bit of the other as well. And so at the bottom, I just put some key factors for you for a defined benefit plan. They're really no longer around. You can't really find those. They're really hard to find. Even if you went to work for an older company like a Boeing or something like that, they may not even have, you as a new employee may not even be eligible for the old defined benefit plan. You only may be eligible for a defined contribution plan. That's just an example of some of the older companies that may have it. And number two for them is it may be in the form of some type of an annuity, right? And an annuity in its simplest form, and so that you'd understand, because you will hear that term a lot when it comes to retirement. An annuity is an insurance instrument and or product that will pay you as long as you walk in this earth, right? And it's built and based off of the mortality table of your life expectancy. That's a little bit more than what I wanted to get into, but that's kind of what a defined benefit plan is. And sometimes you have to make a decision. Do you want a lump sum or do you want payment structured to you? So that is, when you start hearing those terms and those words, you're in some type of defined benefit plan. where an annuity may be generated. They may say, hey, if you retire, we're going to create an annuity and we'll pay you, I don't know, $2,000 a month or $1,500 a month for the rest of your life as long as you walk this earth. That means that you are in an annuity, right? And the defined contribution plan, it's most likely around. You're going to find every company, every newer company, or most every company, at least 90% of them, if they have a retirement plan available, it's going to be some type of defined contribution plan. 100% of that is on you. If you screw it up, you take the money out, or you do some things frivolous to it that they allow you to do within your own parameters, you take money out, borrow against it, and all, that's 100% on you. The company removes themselves of the liability of that. And a lot of them will give you a component or have a selection of pre-tax contributions or after-tax contributions, right? So, and again, last week we went over this thoroughly for the last 2 weeks. We went over the investment pyramid, right? We talked about having cash as our fundamental. We know what we have when we have cash. It's only when we try to make money off of cash is when we try to look at it, trying to get some type of income, some type of savings, some type of CD, some type of bond or something like that. And then it's when we want to try to at least beat inflation is when we move into the own category. Because you're loaning money down here on the income side. If I loan the bank $10,000 for a CD, they're going to, in exchange for interest, then I've loaned my money to the bank. But if I want to buy the bank's stock, then I have to own the stock. I would make more money buying Bank of America stock than Bank of America would pay me for putting their money in the bank. Let me repeat that. I would make more money owning the stock of Bank of America stock or having a mutual fund with Bank of America in it than Bank of America would pay me for me putting my money in the bank, right? And so, but at that instance, I'm owning, right? I own the bank. And so in those categories, the growth in income, the growth and aggressive growth. So we kind of talked about that a little bit for the last 2 weeks. And so what's important and what you need to know, I've dropped the slide back in here. I've put it in here for a couple of different reasons. Why? Because when it comes to retirement, you are going to feel your 401k or your retirement assets are going to feel like an accordion. They're going to shrink. They're going to expand. They're going to shrink. They're going to expand. And the reason why is because every 5 to 7 years, the economy grows and the economy shrinks. We call it contracts, right? Or it expands, right? Companies growing. I mean, the country's growing, people are hiring, right? Or our country is laying off and people are restructuring their businesses. And that's because the federal chairman controls the growth of that. And the reason why they control the growth, the expansion, and the contraction is because of inflationary prices and our pressure. And the brief explanation of inflation is they can't have, and I'm going to take you to an inflationary period of where this will always make sense to you. If you ever want to figure out the reason why what goes up must come down, is when you go back to 2007, I want to say is when we had the housing boom. I was saying between 2007, 2009, I can't remember, or it lasted a pretty long time, but it was either 2005, 2006, somewhere up in there. The economy was expanding so fast, but it had to slow itself down. And that's when you start seeing all the collapses of the banks, Washington Mutual, right? If you even go back and think about some of those companies, Bank of America absorbed Schwab and some other different things, is because there was a lot of debt out there. The reason why there was so much debt out there is because people were using all the money to borrow on bad loans and things like that. That's because the country was growing, but it had to correct itself. And when it corrected itself, it took a lot of casualties with it. And that was one of the things that happened because they wanted the economy started to contract. Here's the reason why, and here's the reason why you need to understand that is because inflation was so prevalent, meaning that if they would have told you a gallon of milk was $20 or a loaf of bread was $5, you would have paid it, right? And that's the theory. It's a little extreme, but that is the theory behind that. That's inflation, because if prices continue to go up, that means there's more money to pay for that. So there was so much money back in the housing boom that if someone would have told you, hey, a gallon of milk is $20, you would have paid it because you would have had it because you had so much access to cash because of the refis and people cashing out and all that. So everybody had money, right? I would go by my friend's house. He had a Hummer, then he had a baby Hummer for his teenage daughter, right? Everybody had money back then. And that's what happened. So the economy had to correct itself. So that fundamentally, that happens. And it's been happening for over 100 years. The economy grows and it contracts. But if you fundamentally put your plans and stuff together, you don't have to worry about that. I'm gonna give you a little something here that it doesn't matter what the economy does, I'm still going to be able to make a little bit of money at the same time. And I'm going to show you that a little bit later here. This is where I explain to you kind of what happened. And there's always going to be booms and there's going to be busts, right? The Great Depression was in 1932 to 1937, right? It was called the Great Depression, the Great Depression, because all the stock market failed 86%, right? And that particular time, a lot went on. That was a contractionary period, right? I mean, so no, the Great Depression was a recovery from that. That's when it gained over 325%. From the Great Depression lasted from 1932 to 1937, right? Between those periods, 1929 to 1932, the recovery was led with a 325% gain over the next 5 years. So it bursted, right? The economy grew. But then there was a post-war boom, right? You had in 1949 through 1956, the economy grew. After the war ended, the United States enjoyed an era of prosperity driven mostly by consumerism. We talked about that already, I think maybe week 2, when we talked about the economy goes as we consume. That's why we got all these checks that we had, all these stimulus checks, because they were trying to grow the economy. They were trying to stimulate it. They were trying to jumpstart it, right? And so that's when you had the boom. So the Great Depression was bad. The boom was good. And then you had the housing boom, right? That's when it was, 2002 to 2007. That was a period we was talking about. It was led by subprime mortgages. Everybody had money. I'm gonna repeat that. Everybody had money. Go back to that time. Everybody had money. And that's why they had to slow the economy down, because again, the cost of goods and services was so much that people said, hey, if you want to pay $20 for a loaf of bread, I got it because I have the money. It's not a big deal. Well, that's not a true reflection of the overall economy. So they had to slow it down. And when they slowed the economy down, they cut back on lending, right? And so it's harder to get loans. It's harder to get money extended to you because the Federal Reserve actually puts those requirements in place. And they tell the bank, hey, cut back on your lending. They give them measurements. Hey, no loan no more than 10%, no loan more than 15%. So they control the money flow, right? And just back now from 2009 to 2019 was another boom. So after we had the bust in 2007, we had another boom in 2009, and it lasted 10 years. And it gained over 334%, the S&P markets. Now, all 13 booms on record has had a bust, but when will history repeat itself again? The reason why there's a boom and a bust because there's a contraction and an expansion, right? It's just fundamentally, that's how it works. That's how our economy is put together. And because our economy is driven by us as individuals, workers, consumers, we drive the economy. If we're not buying, we're not shopping, we're not spending, then the economy is not growing if we don't have money in our pockets. So I kind of got that one, got a lot out of that one. Wanted to explain to you guys what was going on in that. I just wanted to give you the difference. But how's that related to retirement? And what does that mean for you? First of all, you have to know what kind of economy you're trying to retire in, right? And that's why, and I think I put that in my book. I have a book on Amazon. And I put that in my book that you need to at least know your 5-year window. You need to start making your adjustments and preparing yourself for your descent, is what I call it, your descent into retirement. And so there's adjustments, there's things you need to be looking at, what's going on with the economy and stuff like that. And that's when you can make your adjustments and make them accordingly. And again, I just wanted to give that to you again. That's very eerie that you see the contraction and an expansion, but you see the booms and the busts, right? They're going to go hand in hand. They've been doing that for over 100 years. That's just the kind of the way they work, right? And you have to be prepared for that. But I'm going to give you a little something a little bit later. You're going to be able to see that's going to make a lot more sense to you. And this is one of the things that will make more sense to you as we kind of get to the slide. I crossed out aggressive growth, right? I crossed out growth, I crossed out income, and I crossed out cash. The reason why is because growth and income gives you the best balance between contractions and expansions. Why? Because if the economy is growing, I want to get that growth. I want to participate in that, right? I want my money to participate in that growth because I can miss out on that growth. But if the economy is contracting, I'm still going to get income if I have the right investments in the right place at the right time. I'm still going to get income because my mutual fund or whatever investment I selected is going to give me growth. If the economy does well, it's going to give me income regardless of what the economy does. So to me, I call that my sweet spot. Anytime I'm coaching or sharing with my clients, I always say, hey, we want to be right here. We're not trying to get a homer. And I think I shared last week is we're not trying to get a homer. We're just trying to get on base. We want to get on base consistently. You can win a game, or you can ask Atlanta Braves, you can win a game by consistently getting on base. If I get on base, it doesn't matter. If I get a single, it doesn't matter. I'm not trying to hit it out all the time as long as I get on base. If you get in the growth and income category, you're going to get on base every time. And what I do is when I'm preparing and putting portfolios together for my retirement clients is we're going to live here. We're going to live in the growth and income space because we're not going to go broke, but we're not going to be rich either, but we're going to have an opportunity to be able to participate and not do the whole up and down. We're going to be able to still be able to survive of whatever the economy may bring our way. And I'll put this in here and I'll drop this in here for free, right? My pastor always said, I'm gonna give you this, I'm gonna give you this for free. And I think I said this last week, and I don't know how to say this without hurting anyone's feelings. Pastor, like, what is he about to say? Let me preference it, right? Companies, public companies, your AT&Ts, your Targets, your Walmarts, your Hewlett Packards, your Oracles, or your Amazons, they will lay people off to pay a dividend to their shareholders, to their stockholders. I didn't offend anybody, did I, Pastor?
Oh, sir.
That's real talk. I'm just because being in this business 21, 22 years, I've seen it where companies that come out, and I used to work for AT&T a long time ago, and I used to do some technical stuff for them. They laid us all out, but they still paid their shareholders the dividend that was due to them. And when I say dividend, that's a return of profits to shareholders. That's what a dividend is. If you live in the growth and income space here, you're going to own a lot of companies that pay dividends, right? Dividends are not guaranteed, but they try the best to return dividends to their shareholders. And so what I mean by that is when the economy starts to contract, they're laying people off to try to make sure that they're still profitable. That's what companies do. So, oh man, they had a layoff. Why are they laying off all these people? To remain profitable. Because businesses are in business to be profitable. Why are they being profitable? To return dividends to their shareholders, right? And so if you live in the growth and income area, you'll always be able to get some kind of check coming in, regardless of what the economy is doing, right? And I'm gonna have a little exercise here. I'm gonna make you guys think a little bit here a little bit later. We're doing good on time. So again, this is stock, right? This is Exxon Corporation. It's an older stock, it's a stock certificate. That's an equity, right? We talked about it. It is an equity or ownership in a company, right? Now, let's talk about the retirement suitcase, right? And I explained to my clients something I came up with just teaching grad school and a couple other areas about mutual funds. And, I've been all these different places to speak about them. I had to make it easy so people can get in there and can understand it. You guys should know by now, I do a lot of analogies, but this is one that I love to do and I love to teach. What sits behind 85 to 95% of all retirement accounts are mutual funds, right? And I think I talked about it last week. Mutual funds are things that we own collectively together, right? Everybody on this call could be part of our mutual fund because it's mutually, we all mutually got together and said, hey, you put in 10, I'll put in 5, you put in 15, but we all own this one suitcase. Because we all own it, we're able to get it at a reduced cost. Because we all own it, we're able to have a shared risk, right? If I own one company, right, then I'm a live and die with that one company. But if I own a suitcase, and normally the suitcases, I call them suitcases. They're mutual funds, but I call them suitcases. So we'll just call them retirement suitcases, right? And inside of a suitcase, right, are stocks, individual stocks for about 200 companies. So inside of one mutual fund, one suitcase, one retirement suitcase, inside your 401ks, they have different suitcases, right? And it's beyond the scope. I'm going to teach you the fundamental pieces. The fundamental pieces, I want to stay on the surface, but each suitcase is going to have about 200 companies in it, at least, right? Anywhere between 100, 150, 200 companies in it. And these are just some of the companies that I decided to put in here because these are public companies. Anyone on this call can own any one of these companies. Anybody can own McDonald's, Apple, Walmart, Amazon, Facebook, Meta, or whatever they are this week, Costco, Bank of America, Netflix, Procter & Gamble, Carnival Cruises. Anyone on this phone call, anyone on this session can own an individual stock in any one of these companies. The power of a mutual fund, or the power of what sits behind your 401k, is simple. You can all own, everyone can own all of those stocks. There are some stocks that have all of these companies in it. Every last one I just named. I mean, there's some mutual funds that have every single stock that I mentioned here, right? And all of them can sit inside of a suitcase. Now, the suitcase, they're not all created equal. They are inexpensive to own, right? And they are less risky, and they are called mutual funds. That's what they are. So when you open up your 401k at a retirement, if you have a defined benefits plan, there are investment managers that's managing the entire portfolio on the back end, and you don't see them. And they're investing into an annuity, and then you just annuitize it. It's beyond the scope, but I just want to let you know, on the back end, at the very back end, is going to be some type of mutual fund, something that gives you less risk, that's inexpensive to own, right? And it gives you more diversity, okay? Now, they're not all created equal. And what I mean by they're not all created equal, I want to try to stay on the surface here. You have small, medium, and large ones, right? You have some that are domestic only, right? Only USA. You have some that are international only, right? You have some that say, hey, we only do Asia and Europe investments. That's all we do, right? You have some that say, hey, we only do small companies. We only do companies with the size of, no more than 500 employees or whatever, right? And then there's some mutual funds that say, hey, we only do sovereign funds. We don't do smoking, tobacco. We don't do a lot of those types of things. We stay off of that grid. We stay out of those companies. We only do conservative types of companies and stuff like that. You're going to always find a suitcase. You got to find the right suitcase that works for you, right? And that's why I say they could be small, medium, large. They could be international. They could be domestic. They could be medium size. And whatever you find in that suitcase, again, it's going to be about 100 to 200 different stocks or individual companies that you're going to own, right? When we go back to own, right? You're above the line. So if I own them, it's going to give me an opportunity to be able to beat inflation, right? there are some stocks, I want to say Bank of America, I don't have it right in front of me, but they pay a dividend. They pay a dividend of, I think, 3% on an annual basis or whatever. You can own Bank of America stock by itself, beat inflation, and have an opportunity for growth, right? And growth meaning that you bought it for $5, it went to $10, you doubled your money, right? And so I just wanted to go back there because once you move to the own side, that is the only thing that gives you that ability, or you can only play in the own space for an opportunity to beat inflation. Okay, so moving back, they're not all created because of the contents within the suitcase. Now, these are old stock prices, but I wanted to give you a flavor of what they are. So right now, if you wanted to own one share of Amazon, I think it's closer to 2,000 now. This is an older slide, but let's use these numbers for real case scenarios. I know McDonald's is more than $188 a share now, but Amazon.com, if you wanted to own one share of Amazon.com, you would have to come up with $1,690 for one share. Not only would you have to come up with $1,690, you had to live and die with Amazon. So if Amazon had a bad day, they came up and they say, hey, Jeff Bezos, he went to the moon and he didn't come back, right? People might get freaked out about that. They say, oh no, Jeff Bezos not coming back. I'm going to start selling all my shares because I don't know what Amazon is going to do. Well, you bought that one share for $1,690. You wake up the next morning, it's $1,500. You've lost it, right? You're below. And we talked about the three things: guaranteed, you know when you're going to get your money back, and you know the interest rate. We talked about that last week. So when you own individual stocks, you don't know any of those. You're not guaranteed to make any money. You're not guaranteed to make a rate, and you don't know when your money's coming back to you. And so I'm giving you each individual stock price, right? Chevron 118. I think Apple's closer to 200 now. I think it's maybe 200, 220, something like that. All of these stocks are a little bit higher than what they are resembled here, but I'm just giving you an idea. And I'm giving you the numbers for a reason. To buy each one of these stocks, that's the cost. To buy one share of Netflix would cost you $286, right? But I can own the entire suitcase for $43, right? And this is normal when people say, oh, okay, that makes sense, right? So I own all of those stocks for $43, right? I can pay for individual stocks, right? But if I bought Carnival Cruises by itself, and we already know what's going on with cruises, they may not have a good year this year. So I bought it for $60. I wake up in 6 months, it's down to $40. I've lost on that individual stock, right? But if I own it, it's a part of the suitcase. Carnival Cruise may have had a bad year, but McDonald's had a good year, right? Or, Bank of America had a bad year, but Chase had a good year, right? Or so on and so forth. You get the picture. And so when I own them all together in one suitcase, 200 different stocks, I pay $43, right? That's the power of the suitcase, the mutual fund. The best suitcase to have, and I wish you guys could unmute, is the best suitcase to have is growth and income. One that pays you dividends and one that gives you growth as well. Okay. So I'm gonna read this out loud, and I'm gonna just open it up. I'm gonna take one or two answers as we move forward. We're doing very good on time. So I just want to give this to you. I just want to read it out to you. Most of you guys can see it on the screen. But it says, Sam Smith received a call from his friend David the other day. This is just a case study to kind of get you thinking, to see what actually happens in the workplace. Gets a call from his friend David the other day about a good company stock opportunity. He said that it is guaranteed rate of return of 12% for the next 4 years, and that he should invest in it today to get in on the ground floor. So this is what he taught. This is what David told Sam Smith. Man, you need to get in. It's on the ground floor. You got to get in, man. They're guaranteeing 12%. He said that he was certain that he was guaranteed at least 9% in his mutual fund in his company 401k. This is what he said. He says, but I need at least 12%. Then he remembered his financial advisor telling him only 3 weeks earlier that if he could earn 12% over the next 3 years, he could retire. Now, he's 57. He has 150,000 in his 401k. His wife has 200,000 in her 403b nonprofit, or she's a teacher. And they think think that they both should do it because she wants to retire in 3 years as well. Should Sam move his money over to the new investment? What would you do? So I'm gonna take one or two answers and then we'll expound on it and we'll go from there. So anybody can unmute or allow them.
Nothing is guaranteed. We keep saying that over and over. I'm for not doing it.
You for not doing it? Anybody for doing it?
Sounds good. It sounds good, but
it sounds very good.
Guaranteed.
Thank you. I'm glad you participated because you've always been with me, so I appreciate that. Does anybody think we should do it? Anybody want to take the contrarian position on this, or go against Miss Richardson, the baseball player?
What's the aspect what's the risk factor? That's what's not here. Like if he does it, if he goes with the 12%, what's the risk factor?
So you want to explain? You want to tell him, Miss Richardson, or because he wasn't here last week, so we're gonna give him a pass on that.
Yeah, you lose. I mean, the potential of losing, and you're at a retirement age. I don't like to lose in this respect. So I think that.
So are we talking about you?
Great.
Are we talking about you, Miss Richardson, or are we talking about what should Sam Smith do?
Sam Smith is of retirement age. The risk is too great to put all of his eggs in one basket because his buddy is saying it's a guarantee. Nothing is guaranteed. Life is not guaranteed.
This is
why would I do that at a retirement age? But that's just me. I mean,
Yeah, let me be the devil's advocate. Let me be the devil's advocate here.
This is too great for me. But you go on.
No. I make decisions based on the risk involved, not the reward. Rewards look good, but I want to know what the risks are. So when I'm reading this given, he's a good company, a good stock opportunity. I guess what I'm thinking is that, do I have to invest all of my money in this stock, or can I pull some of my money out and put some in this stock to see how it does?
So, and we're gonna move forward, and I appreciate
that.
Go ahead.
Can I comment? One of the things you said to beware of is if someone said they can guarantee it.
Exactly. Exactly.
Wesley. That's what I'm talking about. Thank you, Brother Wesley. Thank you. Because that's what I was going to give to Pastor. We're going to give you a pass, Pastor, because you wasn't.
Oh, here. No. I was just making sure that my members could articulate the reasons.
Okay, I appreciate that. I really do appreciate that. Thank you for doing that. But you were standing so firm. I was like, man, he really actually believe in this. But
oh no.
No, you're good, and thank you. Thank you to Sister Richardson and Brother for bringing that up, because the flag in here was, he said that it guaranteed a rate of return of 12%.
Exactly.
You cannot guarantee a rate of 12%. Nowhere. Because if you do, now you're owning. And if you own, there's risk always. There's no guarantees in owning. Okay. And so when we go back to that, man, I wish I could, let me see if I can, let me go back to that slide. I got to go back because Pastor wasn't here. I got to give you that. Where's that? Where is that? See, it moved. My slide moved. No. There's risk and reward. We talked about that. Here it is right here. This is the slide. This is the one, isn't it, Sister Richardson? This is the one.
That's it.
This is the one. When if you stay, and you weren't here last week, Pastor, so we but we know you was trying to help us out.
No, I was here.
You good. Okay. All right. So again, below, when you loan your money out, there's going to be a guarantee, there's going to be a time frame, and there's going to be a percentage, right? It's when you go above and you own, There is no guarantee. There is no time frame. There is no percentage. Soon as he would have put his money in there, the next day it could have dropped. And he's like, man, I was going to retire 3 years because I lost, because it cut in half. Now I can't retire for another 6 years. And so that was more of a thinking exercise to kind of say, looks good, smells good, but it ain't good, right? And that's what I wanted to give you guys. That was the purpose of that exercise. Nothing more than, I wasn't trying to mess with nobody's heads on a Wednesday night, but I wanted to try to give you something to think about, food for thought. Okay, so here's another one, right? Here's another one full of exercises tonight. We're almost done. If Sam had $1,000 and wanted to buy a mutual fund for his 401k, which one should he buy and how much would he pay? These are mutual funds. So one's a growth and income mutual fund, and one is a growth fund. I'm just throw that out there. We can have anybody help us move this along.
Growth and income.
So you say growth and income. Why? Why do you say growth and income?
Well,
because I told you.
Because you have two options.
Yes.
If the market's doing well, you're going to get the growth, and then if it's not, you get the income if it slows down. And the price is almost the same.
You know what, Pastor? My work is done here.
Yes, sir.
I'm done. No, I'm messing around, but yes, you are correct, right? But what if this happens? Right, the arrow indicates the price after COVID-19. Yours dropped to 44. Your growth and income mutual fund dropped to $44, and the other one dropped to 52. Now, which was the better investment? I'm gonna go back to Brother Wesley.
But I would still get, if that's income, I would still get the dividends from those companies. Okay. And there's no dividends coming from the growth.
Very good.
I totally agree with him.
Pastor, these people are sharp. What are you doing over there at that church? No, and you're spot on. And these are just exercises. I just wanted to kind of get you guys to thinking, because I did kind of hammer on growth and income a lot. But let me tell you even what's more powerful, Brother Wesley, that you probably didn't miss, but you would eventually see if you did it. If the mutual fund dropped to $44, but I told you the average price is $66. I'm telling you here in this illustration, hey, listen, the average price is $66 of this mutual fund. It dropped to 44. That tells me that this mutual fund is on sale. And Mama always likes sales. My mama and my wife. So it dropped to $44. That means that my dividend checks, when they come in my growth and income, when the dividend checks show up in my account, it's automatically reinvest. So that's where the compounding interest comes in. And we're going to get into that a little bit next week. But now my dividend checks, when they're coming in, they're buying the mutual fund at $44 when the actual price is at $66. You see the power in that?
Yeah, you get more shares.
And what did we say? It's going to be an expansion, it's going to be a contraction. So when it comes back, so when I bought the share at $44 and it comes back to $66, who you think looking good now? You're looking good because you bought it on sale. You bought a stock that averages $66, you bought it for $44. This is when people run. When people in their 401ks, they see them doing all this stuff, because you guys have the power to log in and you see your 401k, stop panicking, right? You have 200 companies. All 200 companies would have to all fail at the same time on the same day for you to really, truly lose money. If that happens, we got bigger problems.
That's so true.
Right?
I wish I knew this so many years ago.
Oh.
I would get out. I'm telling you, I would get out, because I'm like, I don't want to lose money. Forget this. I got out. But you're absolutely right. We have to hold on. What Wes said a minute ago, I still have income though. And we have to look at it like that.
That's correct.
So,
That's correct.
It may be low, but I still have income coming in. I still have a dividend check. In my growth, I have no dividend check. So,
Well, and Sister Richardson, one of the reasons I said what I said, it was really not because I believed it. It was, but to tackle the attitude of fear that many
Yeah.
times we have.
Mhm.
yes,
And
very true.
when it comes to this issue, many times I think you just said we don't hold on
You're right.
because we're operating on fear.
Exactly. Exactly. And I'm telling you, that's what I did when I was younger. And, it's just unfortunate, but now, and you keep going from based on what you know. Every time you learn
I
something.
don't want to take his time, but
No.
religion and churches almost facilitate fear in people.
Mm,
Mhm. I can see that.
Unfortunately.
Yeah,
yeah.
I can see that. Yeah. So Pastor, I mean, this is really, I wanted to do this case study. I think I'm done. I have what I did is, I threw this in here and I want to wrap it up for questions. This is something that I created this, part of my company, My Retirement Exit, is I created free trial retirementchat.com. So I created a company called Retirement Chat for people to make these different decisions that they may run into, right, on a daily basis. There's people that call me and says, listen, I got 48 hours to figure out if I want to take a lump sum or I want to take payments. So I already know that, okay, do you have this? Well, no, I don't have that. Do you have that? No, I don't have that. I hadn't thought about that, right? I says, well, I don't know if you need to be trying to, what do you want to do? Well, I want to take a lump sum. Do you have this? I don't know. And so this is one of those things. I created this company to do that. So my retirement exit, we have a lot of solutions for people to kind of help them make these retirement decisions. And this is one of the things that I created. So people, we can hop on the phone real quick, or we can do a voice or a text or something like that. And I created this company, and I was featured on ABC about this because people were panicking when the pandemic happened. I'm like, hey, stay easy, stay the course, right? And sometimes you have to, but a lot of that comes from education, Pastor. And I appreciate you putting this on for your congregation, because a lot of times when you don't know what you don't know. Now, if nothing else, fundamentally, Wesley has it and the rest of the people, Wesley's like, wait a minute, I'm thinking of that logically, I would still be making money, right?
Exactly.
And so that's really, I mean, Pastor, that's really, I wanted to leave the next 5 to 6, 7 minutes or so open for questions and open for discussion, because I know this is a heavy topic. No matter where I go, this is always one of those topics that seems to garner the most questions. So I guess the elder can open it up for questions, or if anybody had questions, or is there anything in the chat that I need to look at, or are there any questions first and foremost for this evening?
I have a comment, Jenny. I just appreciate the suitcase analogy. I mean, last week I appreciated your baseball analogy. Now I appreciate this suitcase analogy, because when you look at it like that, I mean, it really helps. And so thank you. I just wanted to say that.
No, and I appreciate that. Thank you. I had to find a way to make it easier, because I teach this to teens too. I teach this so that they would get it. So I had to break it down to that level. One other thing about the suitcases is, if you're not contributing, I'm going to throw this in here, like my pastor always say, I'm going to throw this in here for free. You don't have to have a lot of suitcases in your 401k, especially if you're not contributing that much. So if you're doing anything less than $1,000 a month into your 401k, you don't need 2 or 3 suitcases. You really only need one suitcase, because the one suitcase has 200
exactly
stocks in it. If you buy a couple of different suitcases, they start to overlap. I got AT&T in this one, but I got AT&T in this one as well. I got Verizon in this one. I got Verizon in this one as well. So a good balance or a good mix would probably be maybe an international suitcase and maybe a domestic suitcase.
Exactly.
You don't need, if you need it too. I would just, if I'm not doing that much, I would probably just get one suitcase and just ride it. I'm sorry, somebody had a question.
Yeah, some years ago, I had a mutual fund. It was American Funds Group.
Oh, American Funds, yes.
American Capital or something like that.
Ooh, I love that.
It was really a good thing, and it took off. But long story short, I had a friend who went to work for a company, and she needed some
Clients?
clients. Yeah. So I let her take this over there, but I told her, look, you can't trade anything. You can't sell anything.
Don't liquidate it.
So she ends up quitting.
Oh,
So the guy she worked for end up taking, over her clientele.
mhm.
And he put me in stocks, and it was during that time, 2009, like you said, the stock market,
I told you. I
did
told you.
very well.
The booms and
you know.
busts.
But now I'm thinking I'm already retired. I'm thinking I probably should get out and go back into a mutual fund.
I mean, I don't know. I don't know your situation. I'm not going to be able to answer that. But yeah, I mean, when you told me that fund you were in, that fund was a firecracker. I would have
Yeah.
never let that thing go. Because
Yeah.
I'm very familiar with American funds and definitely familiar with that particular fund. I think I own that. I actually think I own that one. And that fund has just been killing. So hey, I'm not trying to compound and make it worse for you. I'm just saying that was a very, very good fund. And that's normally what happens is people go to their friend and help their friend out or whatever. Next thing you know, your stuff's messed up. You're like, man, this is my portfolio. This is my retirement. And so there you go.
Yeah.
Yeah. Being in
Jenny,
individual stocks, let me make this one point, Pastor. I appreciate it.
sure.
Being in individual stocks, you can get hurt really, really bad going into retirement. Just riding a whole bunch of individual stock, because Tesla stock dropped 40 billion in value yesterday in one day, individual, right? But if I own it in my mutual fund, it won't hurt as bad. It's like, man, somebody threw me a life raft. I was good. I didn't go under. Does that make sense? So I just want to,
Yeah.
I'm always with the analogies. I'm sorry, Pastor. I just wanted to get that out. Thank you.
No.
That's
That,
good analogy. Another one.
yeah, Jenny, no, that's not a problem. My question is not only for you, but for my members,
Mhm.
and even if we have friends of members or family of members on this, I know you teach teens, Jenny.
Mhm.
My desire and my passion,
Mhm.
we're talking to members that are in retirement or going close to retirement and things like that.
Mhm.
And this is fine, but I just don't know how to get our young people to the table. I look at myself and say, man, I wasn't taught this when I was young.
Mhm.
But not only can I say I wasn't taught this, the church never afforded what we're doing right now
Mhm.
that I can recall.
Yes, it's true.
And so when I talk to young people and young adults, they don't know how to handle finances.
Mhm.
They're struggling as well, and yet they won't come to the table, or they won't come to something like this. And I don't know if you have any suggestions, or really where my mind is right now. We have 2 more weeks, and I'm saying I've got to get Jenny either down here, or I've got to get Jenny on this again for my young adults, for my young people, because they need to know these things now and not when they're, forgive me, for our age that's on here.
Mhm.
This is beneficial to me. It's still beneficial to me, but how much more beneficial could it be to someone who is in their 20s?
Who's got that time? Because you put that time in there, that's the greatest multiplier.
And we know the Lord is coming soon, and many times in church settings, we put off teaching information because we think the Lord is going to come before that time. And my thing is, we need to occupy till he comes,
Right.
and not teach our children to bury things in the sand, but to go to the exchanges, as Matthew 25 says, and exchange their monies to gain interest.
No, absolutely. One of the successes that I've had, even with the young people that I've taught, they have to be together, right? They have to be amongst their age. They weren't going to come to this because
Right.
we're old schoolers, right? Is that what they call us? OGs, right? Or whatever. They don't want to mingle with us. They rather mingle within their same age range, right? And one thing I learned about teaching kids, because I've taught 7-year-olds, right? Different phases, but the age groups have to be close. They can't be large. They have to be close because you're able to talk about the same things in relation, right? And so when I teach the teens who are probably high school or mid-high schooler to first year of college, they're kind of an easy mix because a lot of them are working or doing, so I'm able to talk about different things. And my approach to them is, let's talk about it. Let's, who's got the latest Xbox? Oh, I got it. Okay, boom, boom, boom. You could own, Sony stock instead and make more on Air Jordans and Nike stock than you can, and meeting them where they're at.
Sure.
Right. And not this. This is not even what they're into. The suitcases, I have a different analogy for them and stuff like that. It's the suitcases, but it's a little bit easy. But I take them on a journey of understanding what it takes to operate a household.
So
right?
sometime next year, in other words, we're going to set this up where you're presenting to my young adults.
Okay. Yeah. We talk about the first check. What do you do? What's FICA? Who is that? We break all that stuff down. I'm like, really? I was like, yeah. But one of the best things that I implemented last year, I started doing based on some feedback, and my wife, obviously she's hearing me. I think, baby, you should do this and do that. And one of the things I added was I allowed them to pick occupations, right? And they didn't pick them. I assigned them occupations, and one was a journalist, right? A person that really didn't go to school, had a little bit of school. Then I picked a trades person. Then I picked a person that went to full college and did all this. But I made their expenses relative to where they were, right? Because when you go to college, you have hey, I need to drive the best cars. All the kids got to go to private school. So you have a higher, expenses. And then I asked them, but before we got there, I asked them, how do they want to live? Do you want to live in a 1-bedroom? Do you want to live in a studio apartment? So I take them on these different journeys to make them think, right? Because when I started sharing with my kids our bills, their mouths dropped to the floor. It's like, but that's why daddy be on you. Because I showed them what the bills look like. I was like, wow, that's why you're in college. I don't have to motivate them to go to college. They know why they're in college.
Right.
Both my boys. So yeah, that's where we're at. So Pastor, I mean, me, my strength is 7 to 70, and that's the realm that I operate in. So I appreciate you. I appreciate your church. I appreciate Ms. Richardson rooting for me in my analogies, because that just keeps me fired up. And I appreciate everyone and their good questions and stuff like that. I guess I'll take one more question, Pastor. If anybody has anything other than that, we can wrap it up. I'm good.
Anyone has any comment or question? One last one. All right, I guess we don't. Jenny, again, thank you so much for ending our 4th week. We only have 2 weeks left. 2 weeks left. It's been a joy for those of you joining us via Facebook Live. We thank you for joining us. We want you to know that if you have any other questions, if you need to contact us, you can reach us at 417 South Tamarind Avenue, Compton, California, 90220, or you could reach us at 323-774-0181. We have our service this coming Sabbath, where the title of the sermon will be The Storehouse. The Storehouse. We have a baptism being planned, and we look forward to next week. Next week will be week 5, November the 10th, with Jenny Jones, our penultimate meeting next week. And I've been richly blessed by Brother Jenny Jones's presentations along with everyone here, and that we can take this information and put it and apply it to our daily lives. Invite you to enter a word of prayer with me. Father and our God, we thank you for your manifold blessings. We pray that you would consistently look over us, forgive us of our sins, and remember that we are but dust. Now may the Lord bless you and keep you. May the Lord make his face to shine upon you and be gracious unto you. May the Lord lift up his countenance upon you and give you peace, both now and forevermore. Amen. May God bless us as we endeavor to be the heads and not the tails. Have a good night, everyone.
Word, Pastor. Thank you, sir.
Thank you.
You too, Pastor. Thank you.
Thank you.